Today, the Bond King versus Adams. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In the last couple of weeks, I found myself in an interesting situation, insofar that my regular discussions with Steve Van Metre about inflation deflation triggered John Adams to do some research and make some very interesting claims about the same discussion. And this week, that discussion bubbled up to a head. So you can hear John Adams and I discussing his view of Steve's thesis over on IOTP, where, by the way, John and I don't necessarily agree. And you can also hear Steve and I discussing Steve's views on inflation deflation on this channel. So here are a couple of extracts from each show. Go across to IOTP to see the full John Adams discussion. And I've put a link also to the previous show that I made with Steve Van Metre.
My view on quantitative easing hasn't changed. It's absolutely a reserve swap. So you have a duration asset, a treasury security or mortgage-backed security. And I always like to use the extreme whenever I'm trying to explain something or think through it. You have a 30-year mortgage bond, 30-year treasury bond, and all the Fed's coming in and doing is saying, look, we're going to give you an overnight reserve, which is effectively dollars. Now, you can't pull those dollars out. It's the reserve asset stuck in the system, as you and I have gone over. But it doesn't actually change the fact that it is deflationary, because the key point to quantitative easing becoming inflationary is the banks have to want to lend.
Correct.
And, we look at the senior loan officer survey that the Fed puts out every quarter. Now, what's interesting about this is I did a show about this two shows, because I screwed up the first show when I looked at the chart. Because when you look at the chart, it shows that lending standards were tightening, and in the chart, it looks like they eased. But if you read the actual report, it said they tightened across the board. And what you learned from that, which I got wrong, and lo and behold, I saw Zero Hedge put out an article and they got it wrong, was lending standards tightened just at a slower rate than the prior quarter. So what you're seeing is the banks have the ability to lend against these reserve assets to create money into the system. They're just choosing not to.
Yeah, absolutely. And that is the absolutely critical point, isn't it? So, there may be more money flowing around, liquidity flowing around, but unless it hits the real economy, then it doesn't really have the impact that many people are expecting. Certainly in Australia, it's very interesting. Our broad money measure, which is sort of the amount of stuff flying around, is at 12% annual growth. The lending rate, total credit rate, is down at 2%. That's as low as it's ever been. And it's still looking to me to be going, the same way. Partly because people are paying back more debts, partly because the banks, or while they're wanting to lend, are being very selective. They're not lending to many small businesses. And so there is this massive disconnect between this creation of all this liquidity out in the money machine and what's happening in the real economy. And until the real economy sees some of that flowing into the real economy, I can't see how it can help the economy grow.
Right. And so that almost asks the question, well, is liquidity really liquidity? Because, if I as a business pull my credit revolver, my credit line, and I put it in the savings account because I'm not sure if the Fed or all these other mechanisms that I've been told are going to save me are actually going to work, is it really liquidity? Or am I just, taking that line of credit and parking it there for an emergency purpose?
Yeah.
And I think that's the big difference. A lot of people look at these broad money aggregates in the United States and Australia and all across the world right now and saying, wow, look at all this money that's just dying to flood out in the economy. And yet it's not moving anymore at all. And I think that's just out of fear. And then I also believe that if things were to start normalizing, and not that I expect that anytime soon, is that money's going to go to pay back that debt. Yeah. I think it's just sitting there in the short term just for emergency purposes.
So we have something to clear up for our audience. Unfortunately, Martin, you've created a international monster on YouTube, and it is actually a very serious situation that has occurred because over the last few months on Walk the World, you have interviewed a financial advisor, Steve Van Metre, and Steve has made a very specific claim about quantitative easing and that QE is deflationary. And I've received a number of emails and social media messages from people who have watched Steve Van Metre on your channel, but he's also been on a whole host of other channels. Now, it's interesting that when he appeared on your, I think, most recent program on Walk the World, he actually credited you of the first interview he did with you was his gateway to a whole host of other international interviews that has now made him quite famous.
It's the DFA effect, John.
Yes. So that could potentially be the case. But on a serious point, so Steve Van Metre, after being on your show, he's gone on Real Vision Finance. He's gone on George Gammon's show, which is very popular. He's got a number of other channels, and he's made this very specific claim that QE is deflationary. Now, the reason why I took a lot of exception to it because this is completely, in opposition to what I've been writing about for a number of years, and also what we've been communicating on this show as well as on Walk the World in 2018. And so when I first heard Steve on your show talking about QE is not asset purchases but asset swapping, and that it has a deflationary effect, initially I thought to myself, well, if he's right, then I'm wrong. And if I'm wrong, I've misled our audience for a number of years, and I take a lot of seriousness to ensure that I don't mislead people, and I try to do the most accurate analysis I can. And with all of my published work, it's all freely available on my website, and people can read my analysis and obviously hold me to account about whether I've said something right or wrong. So when I started to hear Steve on your channel, this got me very intrigued because this is an argument I've never heard before. And then I started to listen to Steve on his own YouTube channel, but then some of these other interviews where he goes into, he has a very specific technical argument as to why QE is deflationary, and I've never heard this before until I was exposed to him. And to be honest, I'm glad that I was exposed to him because it forced me to actually investigate. And actually do some research and obviously contact in the Australian context the Reserve Bank of Australia and look at some of the RBA applications. And what I have come away from my investigation is that the Van Metre thesis is false. That it doesn't actually hold water in the Australian context, and as we will get through this show, it doesn't hold in the American context either. Particularly because people have asked me about it, I think it's important that we correct the record and reassure our audience that when people watch in the interest of the people, we haven't so far, to the best of my knowledge, said something that has been demonstrably false.
And just to be clear on a couple of things. The first is that the very specific point we're going to explore today is not in some way debunking deflation as an potential outcome overall. In fact, on the last show, you actually made the point that if we don't get a lot of continued stimulus from the central bank, it will be deflationary.
Yes.
Right? So there are lots of other elements to the whole deflationary inflation future debate.
Yes.
Right? But this is a very specific point, which is actually quite technical at one level, but also very important at another level.
Because of copyright, we can't play some of Steve's interviews where he's gone into some detail. Now, there is one particular interview on Real Vision Finance that he gave with Brent Johnson from San Diego Capital on the 23rd of September. Now that has, as of we speak to today, it has more than 300,000 views. And this argument that QE is deflationary, both Brent Johnson and Steve Van Metre agree that it is, and they spend a 15-20 minutes explaining the reason why. And so if anyone wants to go through, so we'll go through the summary of the Van Metre thesis, but if people want to hear Steve in his own words, that's actually a very good interview to explore, and maybe we'll actually put a link to Steve's interview in the notes, and people can review his argument. And obviously I'll explain why that is. Now, in the last few weeks, Martin, I have gone to the effort of writing a 3,500 word article about the Van Metre thesis, and I've published my analysis of it, and that's on my website. And the article is called "The Fallacy of the Van Metre QE Deflationary Thesis." I hope our audience can be rest assured that the things that we have been saying to them over the last few years is true. It is well researched, and again, I encourage everyone to do their own homework. If we've got something wrong, I'm happy to be challenged. But when people in the last few months have come to me and said QE is deflationary, and I said, well, where are you getting this information from, Steve Van Metre? Hopefully, through my article and through this conversation, we have debunked that thesis in the Australian context and more broadly in the American context. And that when we say that the RBA is doing more quantitative easing, and obviously part of our discussion last week was not that they had reduced the purchasing of 3-year bonds to 0.1%, but they're going to buy 100 billion of 5 and 10-year bonds over the next 6 months. That's going to have an inflationary impact, because once they buy these bonds, that money that they buy it with has been created out of nothing, and it's going to go flow back into the economy as the commercial banks take that money out of these exchange settlement accounts. So I still am on the inflationary side of the fence, and obviously in our last conversation we referenced the conversation with Peter Schiff, etc. And one of the reasons why I am on the inflationary side is because through this creating money out of nothing, that money is going back into the financial system, back into the economy, and that will have a more inflationary impact, because of what we said in our third program back in 2018, that when you take a fiat currency and you increase its volume, well, that has less value relative to everything else, and that's why the value of currencies go down.
Right, and I would argue, John, maybe, but on the other hand, it does depend what happens to the money. Where does it go? Where does it hit the real economy or not? Or does it get sucked into financial markets or other things where actually it's isolated from the real economy? That actually, for me, is going to be the really important discussion ahead. And both posts went up on the same day. And in fact, judging by views, Steve is winning by a short head. But just bear this in mind. Whatever you think about John's analysis relating to the specifics of quantitative easing, the net conclusion from both conversations, it seems to me, is that a deflationary future like Japan and like the Eurozone are certainly valid scenarios. And my own personal perspective still remains that deflation is more likely than inflation. And on that point, I think John Adams and I will continue to disagree. Hey, the thing about DFA, of course, is that I encourage debate and I encourage different voices so that you can make your own mind up. So tell me what you think. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again